So my name is Janos Barberis. I'm a senior research fellow at the Asia Institute of International Financial Law, also academic board of CFT. We've produced research on regulation of financial technology and regulatory technology alongside Professor Douglas Arner at Hong Kong University and Russ Buckley at UNSW in Australia. I'm here today at the OECD at the Competition Committee meeting on digital disruption in financial markets. So financial technology disruption can be looked from two perspectives. Developed market and emerging economies. In terms of developed market, it was a reaction to the financial crisis to recreate competition, for example, in lending. Banks stopped lending to SMEs, peer-to-peer platform emerged. When you look at emerging market, it's however a bit different. The financial crisis didn't have the same stronghold on these economies, and therefore for them financial technology was about market reform, so rethink about payment rails, rethink about credit scoring methods, which also brought more value for customers, but the reasoning behind the development of FinTech was different in both cases. The development of financial technology, if you look at least from a regulatory perspective, is not the regulation of innovation, it's the regulation and the development of competition. The FCA, that used to be the FSA, changed its mandate to one that allowed for competition to enter financial market. And therefore, this is why they allowed challenger banks to enter. But if you look at China, for example, Chinese development was also about allowing more private sector entities to enter financial market as opposed to state-owned banks. However, to do and allow for competition, which means more actors, they also had to allow for failure. And so again, the development of competition as opposed to the development of innovation is what spurred the growth of FinTech. When you look at regulation, there's a difference between regulatory standards and enforcement. And I think standards and rules apply to everyone, but the question is, when do you really enforce? And that's really a cost opportunity. There's three phases in regulation. Too small to care, which could be an individual or a startup doing a financial services activity, which is regulated, but they do that at a size that doesn't really matter. 1 to 1,000 clients, for example, yes, I take deposit, yes, I should be a bank, but I don't want to have a multi-million-dollar compliance department to only handle 1,000 clients. However, when you start reaching 50 to 200,000, you start to become too large to ignore. Then regulators will start looking at you and start to enforce against you. Why? Because you can either create consumer harm or you can start creating systemic risk if you are interconnected. And finally, there is what startups achieve to be, big tech are, or a large financial institution, you become too big to fail. And so that three-step process of too small to ignore, too small to care, too large to ignore, and too big to fail is when enforcement comes in. Regulatory approaches to FinTech, there should be two elements. The first one is proportionate. As we were talking about, depending on the size and the risk that you create either from consumer or on the market perspective, your regulatory burden should be proportionate. Why? Because the reality is most startups, but also tech companies, don't have compliance at core. It's a byproduct that they have to do, but they want to go to market first. And therefore, if you front load regulation, they're not going to go to market, and therefore they're not going to compete in that market. The second element is how you approach regulation. The bottom line is that regulators want to protect markets and protect consumers. And that's really that twin peak approach that, for example, the UK regulators have. We have the Financial Conduct Authority and the prudential regulators. Then you have other regulatory frameworks, which is product-based, banking products, securities, insurance. However, this can create overlap. So it's more onerous on tech companies and startups to deal with three regulators if they're in financial market, as opposed to only two, one that cares about the market and one that cares about the consumer. Reg Tech, which stands for regulatory technology, it's about real-time and proportionate regulation. Reg Tech can apply in financial market, but the reality is actually Reg Tech goes cross-industry. Anything that has a compliance or reporting function to a regulator can benefit from Reg Tech. So as a tool, it's cross-industry. Now in financial market, Reg Tech is something that has been used before, mainly in securities. So if you look at the stock market back in the 90s, the SFC in the US would, for example, look at insider trading backwards. So if there was a peak in stock price, they would look at data 6 months before to see if insider trading was happening. Here they were using data to investigate potential fraud. Now, the availability of data and the mandatory request of regulators or financial institutions to give them data is mandating Reg Tech. Regulators don't have the human capacity to process all that has been demanded to be reported. And therefore, regulatory technology is a cost-effective way for regulators to uphold their mandate, which is financial stability, competition, consumer protection, and financial markets. but it's also an effective way for financial institutions to deliver their service at a way that is not disproportionately expensive because of their regulatory burden.